Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different things that mainly focus outside of the S&P 500 and how other things are interacting with the S&P 500. We look at valuation inside the S&P itself, both on a historical basis and then looking forward. We also do an extensive study on growth versus value. Typically, when growth is outperforming, that means the market is going up. When value is outperforming growth, that means the market is often going down. And then we look at a number of different markets outside of stocks, outside of the S&P 500, because sometimes we can get some clues as to what's happening in the S&P by looking at these other markets. This is being prepared for Monday, June 10th. Before I get started, I do have the SPXInvesting Program now launched. For the month of June, it is free. It'll only cost you an email address. It's hosted on Substack. Please feel free to go check that out. I have a lot of additional things that I post, not only this video, but other videos, especially a daily video that you can get access to before it's made publicly available. And there's other information there that you might find helpful. If you're interested in that, you can send me an email if you'd like. I want to keep it more private. There are links in the description below this video that not only tell you more about the program, but also a description. In the description is a link to go to the website itself and sign up. So feel free to go check that out. If at the end you don't really like what you see, just unsubscribe and that's it. Okay, let's go in and look at S&P 500 valuation. This first chart looks backwards. It's called TTM, or the trailing 12 months. This looks at historical earnings reports and compares them to current price. When we have a PE of 20 or above, that is considered to be expensive. 15 is fairly valued, and 10 or below is considered inexpensive or cheap. The red dashed line is the PE of 20. Way above that is the current price of the S&P. I have it blown up down here on the bottom because we're above zero here. That just means that on a historical basis, the S&P is overpriced. But you can see by looking at this chart, we can go for years at a time where we are overpriced. We don't use this to really make any decisions. This is more just on an informational type basis. Then we can also compare that going back to 1980 to different events and what the valuations were at that time. Another way of looking at this is called the Shiller PE ratio. This takes more of a smoothed approach over a period of time to try to get rid of outliers. And looking over on the right-hand side, the current reading is 34.82. To give us some context, we can look at the historical chart going all the way back into the 1800s. What I do is I compare it to the median and the mean, where we're between 16 and 17, and we're almost double that now as far as the Shiller PE ratio. And so even on a historical basis, looking at it this way, the market is considered to be expensive, but we've been that way for a long time. So again, we don't use this as any kind of a timing mechanism. This is just to give us an idea of where does the market stand. But the market looks forward. There's a thing called forward PE ratios. This is projections made by analysts and forecasts of what they think stocks will earn looking forward, and then compares them to current price. The red line here is the forward-looking PE ratio for the S&P, and we're a little bit above that 20 level at 20.6. So even looking into the future, we're still a little bit over that 20 level, so we are expensive. To give it a little more context, the blue line here are the mid caps, and we're coming in at 15, so they are fairly priced right now. The green line are the small caps. They're at 14.2. They're actually a little bit inexpensive at this point. Just because something is inexpensive, the small caps have really struggled in 2024. It doesn't necessarily mean they're a good buy. There are some other economic forces that are keeping the small caps lower right now. A lot of that has to do with interest rates and then economic concerns. These are smaller companies. They have to borrow a lot of money. When interest rates are higher, that really bites into their earnings. and so their projections are smaller. Now, bigger companies have to borrow money too, but they seem to be able to absorb that a little bit easier, where it has more of an impact on smaller companies. Then we do a comparison of growth versus value. First of all, I just look at growth all by itself, and it's in an uptrend, has been chopping sideways since about the middle part of May. We did see a drop down, but we are kind of range bound right now. We look at value all by itself, also in an uptrend, and has been seeing a decline as we were bouncing up in May, but lately has been chopping sideways. Where we get some insight is when we do ratios between the two. On the top is growth versus value, showing how growth is outperforming. And in a good solid environment, that's usually what we see. Then we look at an inverse down below, where this is showing how value is underperforming growth. You can see where these crossovers with the moving averages are a little bit offset with each other. That's why sometimes I look at the same chart, but upside down. We might see some things that we don't see by looking at it different ways. And I also have shorter term charts and then longer term charts as I go through this. Here is a longer term chart. This is an ETF between growth and value, also showing on a longer term basis how growth is outperforming. And that's what we see in a more positive environment. This is showing how value is underperforming growth. Then here's another look at those same indexes that I showed earlier, showing how growth is outperforming value. And this is a shortened version showing how value is underperforming growth. Then we look again to see how growth is outperforming here when we look at a couple of different indexes. Then we take some ETFs and do a growth to value ratio, and this is actually looking a little bit better. Now, be aware of this because this is a couple of ETFs that we use, and they're calculated in a little different way. The indexes, the ETFs, the different ratios that we follow, that's why I follow so many charts, because they're all just a little bit different. And so we want to get a consensus as to what's happening between growth and value. But this one's actually coming up and going outside of the rainbow. Here's an inverse of that same chart showing how value has been really declining compared to growth. Then we break it down a little further. We look at small cap growth to value, not doing all that well, pretty much chopping sideways. Mid cap growth to value, where it had been doing a lot better earlier in the year, now it's really starting to lag behind. And this is the one that I really focus on. This is S&P growth to value, where we want to see this going up. It's not really doing that. It's not falling apart either. But in a more solid environment, we want to see this ratio really going up. We keep an eye on inflation. On top is a monthly chart of the CRB, commodities, and they've been going sideways, but they're still above the moving average. So they're in a longer term uptrend. Then we do a ratio between inflation and deflation down below. When this is declining, that just means that inflation is not necessarily a concern. If it really starts going down and this ratio really declines, that could almost be deflationary, which is also a dangerous thing. What we're trying to find is the balance between inflation and deflation and try to meet somewhere in the middle. Here is a daily chart of the CRB index where it is in an uptrend. So commodities are going up as stocks have been going up, and they can do that. It's just when one starts to really outperform the other is when we really take a notice. This is the Baltic Dry Index, which has been falling back. It's kind of been scrunching up and chopping sideways. This is what does it cost to send or ship products from point A to point B in the Baltics. Typically, when this is going up, that's more inflationary. When it's going down, that's deflationary. Well, lately we've been chopping sideways here. Then we look at some other markets just to keep an eye on things. Aluminum, which is now in an uptrend, that could be inflationary. Corn, which has been really declining, bouncing up, but then is continuing more in its downtrend. Wheat also bounced up, coming down, but still more or less in a downtrend. This is fertilizer, where we just look over the last 3 months and what is the price of fertilizer. It's going up a little bit, but it's not really shooting higher quickly right now. Oil, which really did spike up when things started to escalate in the Middle East. We got well into the high 80s. We've since dropped back. We got down to the low 70s earlier in the week, and we closed in the mid 70s this past week. Gas, which is in an uptrend but has been coming down. This is more of a political thing because we had Memorial Weekend, and then here's the summer months when people do a lot of driving. And so they're really trying to manipulate things at the government level to drive gas prices down. Plus, this is an election year, and This is one of the things that people really feel the most. They look at food prices, they look at gas prices, and if they're both going up, that can be real detrimental to one political side and really beneficial to the other political side. This is diesel, which has also been declining. This is mainly for trains and 18-wheelers that have to ship products. Heating oil, well, we're in the middle of summer, but still, it has been declining lately. Natural gas is still declining, but it has been bouncing up after really seeing a big downward move. Copper, this is more of a barometer of the economy. When it's really going up, they're projecting that the economy looks strong going forward. Now we're starting to pull back. We're still in an uptrend, but we're not quite sure. Is this profit taking after a nice run up, or are we starting to actually see a shift? Then we do a copper to gold ratio. And when this is going up, like it has been, that just means that copper's outperforming. When this is coming down, that means gold is outperforming. Lately, they've both been under some pressure lately. That's why we're not really seeing a big change in this ratio. Here's a longer term look at that same ratio between copper to gold. And I also plot the 2-year and the 10-year yield on here. We were starting to come up with the copper to gold ratio as copper was doing better. And we're seeing if maybe the distance between the green, red, and black line becomes closer, kind of like it was from 2012 up to about 2016. These are on different scales, so that's not necessarily an apples to apples comparison, but we're seeing a pretty wide spread right now as we've been seeing more of a shifting economy, especially since all of the COVID lockdowns. Gold, which is still in an uptrend, but it has been pulling back lately. Silver also really breaking out, but lately pulling back. Then we look at the closing price for gold on top, which has been declining. Silver also been declining. And we're seeing that the relationship between the two is not as strong as it usually is. And this would only make sense. If gold's going up, silver's probably going up, and vice versa. Well, they've been disconnecting a little bit as silver's actually been a little more active lately. We look at a gold to silver ratio on top. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And interestingly enough, we plot the US dollar index in the middle. They were starting to see a strong correlation between the top chart and the middle chart. Lately, that's been coming down and it's almost back into a neutral reading. And so we're not really getting any insight from this chart. The dollar has been in an uptrend, even though it did pull back a number of days this past week. The dollar going down tends to give support to stocks. When the dollar goes up, that can pressure stocks. There's a longer term look with a trend line where we did break out above this downward sloping trend line. We've since fallen back a little bit, but we haven't come back down to this trend line. That's why I haven't extended it. We keep an eye on the euro, which is in the top, and then the US dollar index on the bottom, just to look at how they're performing with each other. And these are almost a mirror image of the two. Then we plot another one, the Japanese yen on top, which has really been declining, the euro, which is in a downtrend compared to the dollar, and then the dollar index down below. Then I have a breakout chart here. You can see where the blue line is slightly below the red line. That means that the euro is slightly underperforming. Even though we've been above both lines, the euro hasn't really gained a lot of strength compared to the dollar lately. The Japanese yen is in a downtrend when compared to the dollar. British pound is still in an uptrend compared to the dollar. Then we look at different index ratios. I show this in the daily videos where this past week we saw the mega caps doing a lot better than the rest of the market. That's why we're seeing this red line going down and the S&P itself going up. The S&P is a weighted index. So the really big companies like the NVIDIAs and the Microsofts and Google, they have more of an impact, where the equal weight, it treats all stocks the same. And then we keep an eye on the relationship between the two. This is another way of looking at this. The equal weight has been really underperforming the rest of the S&P. That's what we see when this ratio is going down. Then we compare stocks with commodities, showing that stocks are outperforming, even though both are still in uptrends. Here's an inverse, showing how commodities are underperforming stocks. We look at the NASDAQ 100 and compare it to the S&P 500, and both are coming off of recent all-time highs. The NASDAQ was showing a little bit of weakness here, but lately it's been outperforming as tech has been in favor as we've been bouncing back up. The S&P 100 is really outperforming the rest of the S&P 500. These are the biggest stocks, so more of the large cap, not so much Magnificent Seven, but just really big companies that have a real influence. This is the NASDAQ compared to the S&P, both coming off of recent all-time highs. This is showing how the NASDAQ is outperforming, even though they're both doing well. This is what's interesting. We're seeing the NASDAQ 100 start to underperform the rest of the NASDAQ. Now, that could suggest that maybe in a broader measure, NASDAQ stocks are doing better, which that's what this ratio shows. But when the market is really solid and going higher, it's when the NASDAQ tends to be leading it up. And we're not seeing that right now. We look at the mega cap, the really big companies, and compare it with the equal weight index. This is showing how the mega caps are really holding up a large part of the market. We do a ratio between small caps and the S&P. That's the red line. And small caps are just really struggling compared to the S&P. Here's another ratio showing how it's in a downtrend and continues to decline when we compare small caps to the S&P. These are the big software companies, and they're not doing all that great. I mean, we're seeing a real favor in tech right now, and that's where most money is going. But it's going into AI and different areas like that and hardware, where the software companies, they're still in an uptrend, but they're just not performing all that well in 2024. Here's the mega caps. This is what everybody talks about. This is what everybody loves when they're going up. But unfortunately, when we hit difficult times, these go down the most as well. But they are in a solid uptrend. Here's the robotics and AI ETF coming up outside of the rainbow. Not really breaking out, not setting new all-time highs, even though this is where the buzz is at these days. But when we compare it to the tech sector, the robotics AI ETF is actually underperforming, which might be kind of surprising. You would think with the environment that we're in, that we would be up top of the rainbow and actually breaking out. We're actually showing the opposite of that. We're breaking down. This is the Dow Jones Composite Average. We take the Dow, the transports, and the utilities. A lot of this strength in the uptrend that we've been seeing is earlier on, the Dow was doing well. Now it's lagging, but it's the utilities that have really been holding up quite well. The transports have been just chopping sideways in 2024. But when we take all three of these together, we are in an uptrend. This is the S&P compared with short-term bonds. This means that stocks are outperforming bonds, at least on a shorter term 1 to 3 year basis. This is a broader market look at the S&P 1500, also compared with shorter term bonds. So this is confirming that the broad market is outperforming bonds as well. There's another broad market measure with further out bonds going 3 to 7 years, showing how stocks are outperforming on a broad basis. This is a total U.S. stock ETF. This is the biggest one I could find with 2,651 stocks. We're coming off of just setting recent all-time highs. This also suggests that the broad market is holding up. Low volatility stocks, they're in an uptrend when we look at them all by themselves, but when we compare it to the S&P, they are really underperforming. The tech sector to the 3 to 7 year bonds, we did see a little bit of a pullback, but now they're starting to break out upside of the rainbow, meaning that the tech sector is outperforming. And here's the advanced decline line studies, and I show this in the daily video too. The NYSE common stock is coming back down to its moving average. The S&P is still above its moving average. Where we're seeing some weaknesses with the mid caps and small caps, where they're starting to drop below their moving averages. Then here's traditional Dow theory, where we did set an all-time high with the Dow, and then it's been really pulling back as we've been marching through earnings season, and it's bouncing back up a little bit. Then we look at transports, which really have not been going anywhere in 2024. That's traditional Dow theory. Now, I add utilities to this as well, where utilities were really going up strong. They were pulling back, then bouncing. Lately, we've been seeing more of a pullback here. Then the transports, this has just been really a disappointment for the market in 2024. We're just chopping sideways. We look at a ratio showing how the transports are really underperforming the S&P. We look at the Dow versus the transports. When this is going up, that means the Dow is outperforming. And the Dow's been struggling, even though it's not falling apart. But the fact that this is really going up in spite of the Dow struggling really shows how weak transports have been. We look at the correlation between the S&P on top and transports, and they're not having a strong correlated relationship. The S&P has been going up as the transports have been either declining or going sideways at best. This is a new look at Dow theory where instead of using the Dow, we use the S&P, which is coming off of all-time highs. On the bottom, instead of using the transports, we use the NASDAQ, which is tech, also coming off of recent all-time highs. So this is looking healthy. When we see a bit of a discrepancy is we look at an equal weight version of the S&P on top, and notice how that did not come back and has not set a new all-time high. We look at an equal weight of the QQQs, which is the NASDAQ 100, also not setting a recent all-time high. So these are confirming each other, but when we take both of these charts, compare them to the regular indexes, we're seeing a negative divergence here. And that's a bit of a concern and something that we've been watching and will continue to watch. The FANG index is coming off of setting recent all-time highs. This is just a chart that I have here in case we really start to fall. I'll be trying to pick out different support levels. The Wilshire 5000, a broad market measure, when we were going down in May, we came all the way down to the 50-day moving average, and then we were able to bounce up off of that. ARK is really struggling right now. If we continue to go sideways like it has been, we're just about ready to see a death cross with the longer-term trend of ARK. All world, when you take out stocks in the US, that's performing quite well. But when we compare it to the S&P is outperforming that same ETF that we just looked at. And here's a monthly chart looking at a ratio between the S&P and global stocks. Another look here, where when this is going up, that means the S&P is outperforming. The red line is going up, and we're above the red line. So U.S. stocks are outperforming stocks in Europe, Australia, Asia, and the Far East. We do plot an oscillator down here to measure momentum, and this is a monthly chart, so it takes a while to change, but this has been declining a bit. Keeping an eye on bonds, where we have bonds based on price been chopping sideways, but they're still in an uptrend. These are world bonds, which are just bouncing around all over the place. They're actually getting close to a death cross here, but not quite yet. We look at a monthly chart and see how stocks are outperforming bonds. This is a daily chart showing how bonds are underperforming stocks. Now, if you take this daily chart, I also have a weekly chart of this same thing, also showing how bonds are underperforming. And then we can just compare this, and then the monthly chart that we just saw, we can see on all the different time frames where bonds based on price are underperforming stocks. These are high yield corporate bonds. We also know them as junk bonds, just coming off of setting recent all-time highs. These are more conservative bonds called investment grade corporate bonds, where they're in an uptrend too, but they have a ways to go to get back to their all-time high. We do a ratio between junk bonds and more conservative bonds, and folks are still preferring the riskier bonds. They're willing to assume that risk to get a higher yield. We look at the correlation between stocks and bonds, and they have a fairly strong tendency to be going in the same direction. That could be either up or down, but they tend to be moving more in tandem with each other. Here's the Dow Jones Corporate Bond Index, been chopping sideways for most of 2024, but still in an uptrend, but has not broken out yet based on price. Here's a Fibonacci study with the 10-year yield, not really showing us anything now. This is a longer-term look at the 10-year yield, where we are starting to break out into areas that we hadn't seen in over 40 years. So we're starting to shift more towards a higher interest rate environment. Here's the 30-year yield. Again, not really hitting any fib retracement levels right now. We compare the S&P with the 10-year Treasury yield. This is showing how the S&P is outperforming the 10-year yield. This, and I've been using this quite a bit in some of the daily videos. When this is going down, that means the bonds are underperforming, which means stocks are outperforming. And if you're positive on the market, that's what you want to see. Junk bonds also coming off of, didn't I just show this? Setting recent all-time highs. Interesting. Here's a junk bond to more conservative bond ratio, showing how junk bonds are outperforming. This is the 7 to 10-year bond based on price, where we had been going up as interest rates are going down, but this really dropped on Friday, and that pressured stocks. Here's a daily chart of the yields where we had been declining, but then we saw the tick up in Friday's session. Here's a weekly chart showing how we saw a bit of a downtick US, UK, and German rates, and Japanese rates, which are a lot lower, actually declined a little bit this past week. We look at the MOVE index, which is the volatility of bonds on top, and VIX, which are the volatility of stocks in the middle area. And we see that the relationship between the two is almost neutral right now. So we're not really getting any insight from this chart. Then we look at a monthly chart of the price of the 30-year bond, which is in a long-term downtrend as interest rates have been going up. On the bottom, we do a ratio between the 30-year bond ETF and commodities, showing how the price of bonds are still doing better longer term than the CRB index. Then what I do here is I just look at the 11 different sectors in the S&P individually, and then I compare them with the S&P. So materials have been chopping sideways, but they are in an uptrend. But when we compare it to the S&P, they are underperforming. Communication doing quite well here and in an uptrend and actually outperforming, but lately has been chopping sideways when compared to the S&P. But this has been one of the stronger areas of the market. Energy, keeping an eye on that, where it's in an uptrend, but we have been pulling back lately. And it's going back to underperforming the rest of the S&P, where from March up until about the end of April, this was really starting to bounce back up. Now it's starting to pull back. Financials still holding up okay, right along their 50-day moving average here on the daily chart, and doing okay, but still in an uptrend, but lately have been pulling back when compared to the S&P. Industrials also in an uptrend, but below their 50-day moving average, and now really starting to underperform the S&P, where this had been a stronger area from about February until the latter part of April. Now we're seeing this really starting to underperform. Tech, this is the darling that everybody loves, came right down to the 50-day moving average, bounced up off of that when you look at it by itself. And it's not really breaking out right now, but it's still holding up okay when compared to the S&P. Staples, this is a defensive area and something that I've been showing in every daily video because we're seeing a pretty solid uptrend here. It also came down to its 50-day moving average and then bounced up off of that. But when you compare it to the S&P, it is underperforming. But again, this is a more defensive area, so we're just keeping an eye on this. Real estate really suffering on a relational basis, but still in an uptrend when you look at it by itself. This is where we see a real breakdown, how real estate's underperforming the S&P. Utilities, which have really been going up, now we're seeing some profit taking. We don't know if that's just a pullback before it's going to go higher, or is the actual chart going to change over to more negative. And we're just starting to see a golden cross here with the ratio between utilities and the S&P, where they had been really underperforming. And then about the beginning of March, that's when they started to really outperform. This is another thing that I keep a close eye on. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means the S&P is underperforming. We want to see this ratio going back up to be more positive. Healthcare, another defensive area, because you have to have healthcare no matter what's going on in the economy. This is in an uptrend, but when we compare it to the S&P, it is underperforming. Discretionary, going sideways when we look at it, but still in an uptrend. But this has been a real disappointing area of the market where it's really underperforming the S&P. We want to see discretionary, tech, communication. Those are the big growth areas. And communication and tech are doing okay, but discretionary has been really underperforming. Those are more offensive areas rather than defensive areas. Semiconductor, the ETF here, semiconductors, this is one of the strongest areas and one of the biggest areas when it comes to tech. So that this is in an uptrend and not quite setting a new all-time high, but near all-time highs. That's positive. We look at the energy sector and compare it with tech. When this is going down, that means energy is underperforming. It was starting to come back up, but now it's starting to pull back down as tech has been outperforming lately. Growth stocks versus bonds, just showing how growth stocks continue to outperform here. And the tech sector with the 10-year yield, showing how the tech sector is outperforming the 10-year yield ratio. This is an inverse of that, showing how the 10-year is underperforming the tech sector. Discretionary versus staples. This is more offense versus defense. And this is breaking down. And we actually saw a recent death cross with this ratio. That just means that I should have changed this. This means staples are actually outperforming currently. And this is also showing how staples are outperforming when compared to discretionary. Gold, which has been pulling back lately, we're actually seeing a recent golden cross here when we compare gold to the S&P, but it's been pulling back and dropping below both moving averages with this ratio. Also, gold has been outperforming the dollar. Even though the dollar is in an uptrend, it has been seeing some recent weakness. This is pulling back a bit as we've been seeing some recent weakness in gold. This is an area that I really focus on. This is high leverage loans, very risky loans. We're just going and setting a series of higher highs here and barely coming down to its moving average, even when we run into trouble. So this is suggesting that going forward, the economy is still looking pretty good and the market is still looking pretty good. You can see back in 2022, the difficult year, well, this ETF was really having some trouble then, but since then, we've established a really strong uptrend. The NYSE composite, a broad market measure, also about at its 50-day moving average and in an uptrend. All stocks also, that includes US and international stocks, in an uptrend. Emerging markets chopping sideways, but they are having a tendency to go higher. The Japanese Nikkei, which finally came back and set a new all-time high that was set back in 1989, even though it's just a little bit under that level currently. The small, really small stocks called the micro caps, they are still in an uptrend. And then on top, we have the S&P, then the home builders ETF, and then here's a ratio between the two. We're not really seeing anything. What we look for are divergences, negative divergences here. And that's when we get down into these other areas where I mark it in yellow. We're not really seeing that right now. Bitcoin, which is just a little bit above 72, then currently it's at about 69. It saw a bit of a pullback late last week. Here's a long-term look at the trend in China using the KST, another momentum oscillator, where we've been declining in China, emerging markets, holding up okay in Europe, actually starting to see a bit of a downturn in Japan, and pretty much flat looking at US stocks. Here's an intermarket analysis chart where for the first time now in a while, we see stocks performing the best going back to the beginning of the year. Then we see gold, then we see oil. For a while, we were seeing oil in first place. And then the dollar, that's the green line. And then bonds based on price are actually down year to date. Then the next part looks at different correlations. We compare the S&P 500 with the dollar index. They're having a slight tendency to go in opposite directions currently. We look at the S&P to oil, also a slight tendency to go in opposite directions. And the S&P to the 10-year yield, also more of a tendency to go in opposite directions. If interest rates are going down, that typically lately has been helping stocks to go up. And if interest rates are up, that's been putting pressure on stocks. We look at the tech sector, compare it with the 10-year yield. This relationship right now is neutral. Look at shorter term yields here with the 2-year, also a slight tendency to go in opposite directions. And then some long-term studies here. This is a monthly chart of the NYSE composite. We're above the red line and going up, so that's positive by itself. The Kopit curve, which is a momentum oscillator, continues to go up. This is a daily chart, and we have an indicator down here called the record high percent index. This is going up. So we're looking strong here on the daily chart. Here's the S&P with a monthly chart. We're above the moving average, and the momentum oscillator is starting to turn back up. That's positive longer term. We look at the S&P on top, and then a ratio between stocks and commodities showing how stocks are outperforming. Then another monthly chart looking at a global index showing how the S&P is outperforming, but the KST is right on top of its moving average currently. So, but this is a monthly chart and it can take a while to develop here. Then the last thing that I do is I go through and I say, what are those things that are positive? And I don't know if the spacing is going to line up here. My definition of positive as it applies to this video is when the 50-day simple moving average is above the 200. And everything that you see listed here is positive. So you just kind of look at all these different things instead of me just reading it off to you here. We should end up with Bitcoin somewhere near the bottom. Okay, Bitcoin is still down below, but it's on the list. We have a pretty short list of negative things. We only have the Japanese yen and the euro compared to the dollar. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.